The technical versus fundamental analysis. The attempt to predict accurately the future course of the stock prices and thus the appropriate time to buy or sell a stock must rank as one of the investor's most present endeavors. This search for the golden egg has spawned a variety of the methods, the ranging from the scientific to the occult. There were people today who forecast the future stock prices by measuring sunspots, so looking at the face of the moon, or the measuring the vibrations along the San Andreas Fault. Must be, however, opt for one of the two methods, technical or fundamental analysis. The alternative to techniques used by the investment pros are related to the two theories of the stock market I covered in the part 1. Technical analysis is the method of predicting the appropriate the time to buy or sell a stock used by those believing in the castle in the air view of the stock pricing. Fundamental analysis is the technique of applying the tenets of the firm foundations, the theory to the selections of individual stocks. Technical analysis is essentially the making and interpreting of stock charts. Thus, is pretentious, small but abnormally dedicated cards are called as chartlists. They study the past, both the moments of the common stock prices and the volume of trading for a clue to the direction of future change. Most chartlists believe that the market is only 10% logical and 90% psychological. They generally subscribe to the castle in the air school and view the investment game as one of anticipating how the other players will behave. Charts, of course, tell only what the other players have been doing in the past. The chartlists' hope, however, is that a careful study of what the other players are doing will shed light on what the crowd is likely to do in the future. Fundamental analysis take the opposite tack, believing that the market is 90% logical and only 10% physiological, caring little about the particular pattern of the past price movements. Fundamentalists seek to determine an issue's proper value. Value is the case is relative to the expected growth rate of earnings and in dividends, interest rates, and risk. By estimating such factors as the future growth for each company, the fundamentalist arrives at an estimate of the security's intrinsic value or foundation of value. If this is above the market price, then the investor is advised to buy. Fundamentalists believe that eventually the market will reflect accurately the security real worth. Perhaps 90% of the Wall Street securities analysts consider themselves fundamentalists. Many would argue that the chartists are lacking in dignity and professionalism. Okay, so in this case, I think I already told you guys about why I start investing, and so at the moment, so back then, the break out the COVID-19 around some April, the early April, 2000, 2012, 2020, the last year, and so, at that time in Korea cases Kospi the figures plunged down. It's really some almost a dead stock, and stock market is almost dead, and so it's almost some companies underrated at the time, and then people some some the waiting for when the stock price go up or the figure go up, the Korean economy go up, or global some trends, or global manufacturing some trends getting better. So in my case, so do I, and this book show us a little bit some same thing. So how can we to estimate the fundamental or some technical things? But at the time is definitely some fundamental is a really stable countries. I mean the companies in Korea, so we have many manufacturers, some company, and they have some share the stock market. So I did, and I can get almost a small amount of money, and I realized, oh, I can so make money like that. I can so make some profits like that. And okay, let's see the next paragraph, next chapter. So what can charts tell you? The first principle of the technical analysis is that all information about earnings, dividends, and the future performance of a company is automatically reflected in the company's past market prices. A chart showing these prices and the volume of the trading already comprises all the fundamental information, good or bad, that the security analysis can hope to know. The second principle is that the prices tend to move in trends. A stock that is rising tends to keep on rising, so whereas a stock at rest tends to remain at rest. A true chartalist doesn't even care to know what the business or the industry a company is in, as long as he or she can study its stock chart. A chart in the form of an inverted wall or the pennant means that the same for the Microsoft as it does for the Coca-Cola. Fundamental information on earnings and dividends is considered at the best to be the useless, and at worst a positive distraction. It is either of inconsequential importance for the pricing of the stock, or if it is important, it has already been reflected in the market days, weeks, or even months before the news has become public. For this reason, many chartists will not even read the newspaper except to follow the daily price quotations. One of the original chartists, John Magee, operated from a small office in Springfield, Massachusetts, or even the windows were boarded up to prevent any outside influence from distracting his analysis. Maggie was once quoted as saying, "When I come into this office, I leave the rest of the world outside to concentrate entirely on my chart. This room is exactly the same as the blizzard as on a moonlit June evening. In here I can't possibly do myself and my clients the deserved of saying goodbye simply because the sun is out or sell because it is raining." As shown in the figures opposite, you can easily construct a chart. You simply draw a vertical line whose bottom is the stock's low for the day and whose top is the high. These lines cross to indicate the closing the price for the day. In the left-hand figure, the stock had a range of the quotations that day between the 20 and 21 and closed at some 20 to first second for first two. The process can be repeated for each trading day. It can be used for the individual stocks or for one of the stock averages that you see in the financial pages of most newspapers. Often the charter list will indicate the volume of the shares of stock traded during the day by another vertical line at the bottom of the chart. Gradually, the highs and the lows in the chart of the stock in question jiggling up and down sufficiently to produce the patterns. To the chart list, this pattern have the same significance as the X-ray plates to the surgeon. One of the first things the chartist look for a trend. The right-hand figure above shows on the making. It is the right-hand figure always shows on the marketing. It is the record of price changes for the stock over a number of days, and the prices are obviously on the way up. The chartist draws two lines connecting the tops and bottoms, so creating a channel to delineate the uptrend, because the presumption is that the momentum is the market will tend to perpetuate itself. The chartist interprets such a pattern as the bullish. Arguably, the stock can be expected to continue to rise. As Maggie wrote in the Bible of the charting, the technical analysis of the stock trends, price is moved in trends and the trends tends to continue until something happens to changes the supply-demand balance. Suppose, however, that at about the 24 the stock finally runs into the trouble and is unable to gain any further ground. This is called the resistance level. So the stock may wiggle around a bit and then turn the downturn. One pattern which chartists claim labels a clear signal that the market has topped out is head and shoulders formation, shown in the next figure. The stock first raises and then falls slightly, forming around its shoulder, is raised again going slightly higher before once more receding, forming its head. Finally, the right shoulder is formed. The charterist waits with bated breath for the cell signal, so which sounds so loud and clear when the stalk pierces the neckline. With the glee of the some Count Dracula surveying one of his victims, uh, the chartalists are off the sailing, anticipating that a prolonged the downtrend will follow as it uh, illegally has in the past. Of course, sometimes the market surprises the chartalists. For example, the stock may make an end run up to 30 right after giving a bear signal. A bear signal. As shown in the following chart, this is called the bear trap or the chartalist, the exceptions that test of the rule. It follows from the technique that the chartalist is a trader, not a longer-term investor. The chartalist buys when the arguably looks favorable and sells on the bad omens. He flirts with the stocks just as some flirt with the opposite sex. His scores are successful in and out trades, not rewarding the long-term commitments. Indeed, the psychologist Don D. Jackson, author with Albert Hassis Jr. of the Bulls, Bears, and their Fruit, suggests that such an individual may be playing a game with overt sexual overtones. So when the chartalist chooses a stock for the potential investment, there is typically a period of the observation and the flirtation before he commits himself, because for the chartalist, as it romance and sexual conquest, timing is essential. There is some mounting excitement as the stock penetrates the base information and raises higher. Finally, if the offer has gone well, there is the moment of fulfillment, profit taking, and the release and afterglow that follow. The chartalist vocabulary the features such terms as double bottom, the breaking through, violating the rules, some form of big play, exceeding the peaks, and buying climax, and all this that takes place under the pinnacle of the greatest symbol of the sexuality, the bull. And also, this chapter, and uh, I'd like to say something to the first one, just the two paragraph. The second paragraph. So is the chartalist says so we can some analyze the chart and we can predict a little bit in the future and that kind of things, but in my case it depends on some industry, because some industries so really it's like fluctuations really quick and really some quick, and some terms really short, and some industries so rarely change or some steadily up, steadily down, and so on. But nowadays, in the biotechnology is really volatile, and so the terms are really short, and some surge up, plunge down, and up and down is really quick, I guess. And some energy or some energy to all the chemical, it depends on the chemical, but the, the generally some oil petrochemical industries some steadily up and steadily down, the up cycle and down cycle, and so we can estimate a little bit and that trend, and so we can put our money and asset, and the trend to your asset, so getting bigger and bigger. And so the last one, so they explain how can we expect some chart, so through the past chapter, the chart some history, but in my case it is hard to believe that theory, and so yeah.